So I'm Alejondro Solé. I'm the Chief Investment Officer of TechEnergy Ventures. That is a corporate venture capital of TechIn Group. TechIn Group, it's a privately owned company that works in the energy, steel, and EPC segments. Globally, we have a large footprint in Latin America. And as part of the challenge to decarbonize hard to abate, and as part of the opportunities to be part of this energy transition, the energy company launched energy transition division that also includes a fund that we launched 2 years ago in January 2022 that looks for technologies, hardware technologies that then we can implement and use on our ambition to develop energy transition assets. Hydrogen, carbon management, sustainable mineral extraction, and as well as clean power and new technologies in that segment. So firstly, there's no technology that fits all the cases. When you go straight to the numbers and you try to think the cheapest way to decarbonize it, considering that there's trillions of dollars of infrastructure around steel. So the cheapest marginal cost to decarbonize is carbon capture, generally speaking. But there's a lot of challenges with carbon capture. You need to have a sequestration option or a utilization option. So, it's not really available for all the assets that we have today. More and more, we're seeing companies doing the reduction through hydrogen or trying to move towards hydrogen. Hydrogen can be an attractive option, but it's obviously expensive. It's expensive to produce it. If you compare it to natural gas, the economics are a little bit challenging, but it is a viable technology available today that works. And a company that is part of a group called Tenova is one of the leaders in this DRI technology, hydrogen ready. It also provides the steel industry an option to continue to invest in a technology that today maybe they can use with natural gas, and then they can switch as also the demand for clean steel starts to appear in a more, I would say, scale or massive way. Today is still a small niche, the demand for green steel. And then obviously there is all the new novel technologies that are coming out that are very interesting. These are completely different processes that try to use low temperature. For example, we are an investor in a company called Ilios out of Israel. And Ilios has a sodium technology that can do the reduction of ore at very low temperature. So typically there's a new bucket of new technologies that are going to become available more and more. This takes time. It's not an easy industry. A reasonable plant, it's a couple million tons. So these are massive facilities, and there's a lot of scale-up risk. But there is a bright future, we think, in the steel industry with some of these new technologies coming up. I think it very much depends on what type of steel product you're actually doing and what's the impact on the full construction of whatever product ultimately the consumer is buying. So, today we heard how much is steel within a car. It's fairly low. So for BMW to sell maybe let's say a carbon neutral car, they can probably pay a green premium. Now, if you flip that around and you go to a construction, it becomes a little more difficult. So really you see the green premium effect in those segments that really the incidence of steel is low and the customer is paying for not a commodity, but a product that can be priced on a different way, and eventually a green premium can get incorporated into the full cost without significantly affecting the full cost of the product. So, I think you need to find those niches, but in the end, they're a little bit niches because when you look at the bulk of the demand for steel, construction, for example, is a big part of it. So, what we see is companies getting ready to decarbonize, making investments that are not going to become stranded when the demand for green steel becomes the norm and the base, and starting to look forward into how can they integrate more efficiently into a new supply chain that demands cleaner products, not only for steel, but for any product in the market. It's clear, this year we've seen H2 Green Steel raising almost $5 billion to build this plant, raising debt on a green steel project. So it's very exciting. It clearly shows that there's real economics behind it, and it's very, I would say, encouraging for everybody in the steel industry to also think about how they can build a business case with a green steel that it will be more expensive, but it can find markets for sure. It's interesting, the two different approaches. I think the first observation that we typically do is that Europe, while it's more a little bit of a stick policy, you need to do this, which it's not as incentivized as in the US, that is a carrot. Here you have $3 per kilo of hydrogen and go build it. In general, we like the structure of the European carbon tax scheme as a more permanent way and as a way, I would say, the world should work, where if you emit, you pay, and you find the cheapest way to decarbonize yourself, and you then make a business case for each situation. We think that's more efficient from a tax perspective. But then from a subsidy and trying to get things moving forward and trying to get the companies to go through the learning curve to get the cost down, the IRA and what the US is doing it's clearly has a much bigger impact. So I think Europe is now reacting a little bit to IRA. IRA is creating a flux of entrepreneurs that everybody wants to put their first plant, the first manufacturing facility. Anything you want to do in energy transition, it's today a little bit easier to get government support in the US. And Europe, is trying to respond. Ultimately, the challenge that we see is that hydrogen, it's a variable cost-driven product. When those incentives disappear, there's going to be a lot of assets that are going to be a little bit in positions that could become stranded because it made sense while someone would give you $3. When that's gone, you still got to pay 50 kilowatt hours per kilo. So it's a lot of energy. So we'll see. We think that now to go through the learning curve is very effective. Then whether those assets are effectively built in areas that make sense and can sustain themselves without a government subsidy, it's yet to be seen. So there's two sides of the coin. We think the more challenging part is the use case, because when somebody makes a decision around using hydrogen today because of all these incentives, when those are gone, the question is whether that decision will remain and will sustain. Today, not to pick a specific example, but there's a lot of discussion around hydrogen as a fuel. I think generally speaking in the industry, there's strong conviction that it will be, and it is, a fantastic feedstock. But then everybody wants to push it a little bit as a fuel. And you see California, cars, trucking, everybody pushing through hydrogen as a fuel. The question is, when you actually have to start paying that bill, how many people are going to sustain or keep that decision of using hydrogen as a fuel? So in the end, like all these incentives that are very bold and very, I would say, large, end up creating some market situations that when the subsidy is gone, we'll have to figure out what happens to that installed capacity. On our framework, we would call hydrogen to produce a SAF a feedstock, right? So the same for ammonia. So for us, that's the category of things that make a lot of sense and the things that will happen. So ammonia needs to become green. That's a large demand of green or clean, low carbon hydrogen. And then you have the SAF category, and you have 8.5 million barrels a day that are being consumed. And there's a question of can we deliver a carbon neutral product that can help decarbonize the airlines, or what other options do we have for airlines? Because obviously today we saw an electric airplane get presented, but 70% or more of the actual consumption comes from long-haul flights. And that is the hardest part to decarbonize of the entire airline industry, and there's really no other option today. And it probably won't be in the next 30 years. So then you say, okay, what tools do we have today? And the reality is that we do believe that as hydrogen goes down in cost and there's more availability of CO2, you will be able to get a SAF product that will be cost competitive with fossil. Obviously, fossil prices changed, and today we're in a fairly expensive market, which makes it a little bit easier. The caps are a little bit smaller, but we think that we will get to parity. Eventually, the emissions of the airlines will have to get taxed, which will help close the amount of green premium that would need to get paid. And then, obviously, the blending helps the market get going. But what makes us confident about the segment is, first, it's the size. This is almost $1 billion per day market, right? So the question is, we don't need 50% adoption for this to become a reasonable market. The blending, plus the cost coming down, plus some clients willing to pay for a green premium, plus some airlines trying to differentiate themselves by having low carbon or low impact flight offerings. All those things will help get some of that market, which if it gets to 20%, it's already an incredible opportunity for the energy transition. We hope that it's going to get to 100%, and that's what we need to get to net zero. But we're confident that we'll be able to have the building blocks to get the industry going and ultimately get to that price parity, and then make it much more easier for consumers to make a decision on a very low cost impact for flying without a CO2 impact. So we talk a lot about solar to molecules as a concept. And one of the main elements of this concept is that in an area where you have limited amount of green electricity, if you use it for hydrogen, it's actually probably the worst use, because you could be displacing other forms of generation to be used as electricity, which has a much better impact on the CO2 reduction. So generally speaking, we are believers that for anything that is as a feedstock, the new supply chains will be in areas where there is no today energy demand or electricity demand, but have an incredible solar radiance. So basically that we can get to levels of 2,000 hours and above. And in those places that are isolated, the best way to get that electricity, that cheap renewable electricity out, is to produce ammonia or to produce SAF. So take it out in the form of a molecule. And then that fuel can be used globally and can be used in many places, and we can get exported basically. So our perspective is that the long-term infrastructure around SAF and ammonia and anything that uses hydrogen as a feedstock will occur in places with very cheap solar. They're going to be basically built up to produce molecules. And that's a little bit how we see the world evolving through time. Today, the incentives will drive other decisions. But in the future, we think that that's going to be more the case. There's obviously challenges around intermittency. We have to see what role do batteries play, intermediate storage options. You're going to go from a probably intermittent hydrogen production that you want to go into a continuous downstream, further refinement into whatever molecule you're trying to do. So there's still a lot of things to figure out. But what we do think is that if you want to get to $1.25, $1.50 hydrogen, you need $15 megawatt hour electricity. You're not going to get 50 megawatt hour electricity anywhere that is connected to a grid, because the demand for green electricity is huge. So to think that technology will drive the ability to offer cheap solar down. So that's going to happen. But in the markets where there's a limited demand for clean electricity, it's not going to become that cheap. It needs to happen somewhere where there's no demand. You're creating the demand because you have the solar resource. And because you have the solar resource, you can get to the lowest cost of hydrogen, and then you can get to the lowest cost of ammonia, and so on. So we've run these numbers many times. Clearly, it has a lot of unknowns, and we have to see how the actual costs of batteries and the efficiency of batteries evolve through time. We are more today thinking that you're going to rather have intermittency, because electrolyzers, we, for example, are big believers in AM as potential the lowest cost electrolyzer. We believe it's going to be cheaper to produce intermittent hydrogen as a first step with a cheap electrolyzer and a low capacity factor than trying to add the batteries, lose some electricity on the way because you have a round trip efficiency with 20-25% losses. So it already puts your electricity at a higher cost. So we think it's going to be intermittent hydrogen, some format of buffer for hydrogen, and then a continuous last step.
Right.
But again, these are all extrapolations of numbers that they still need to materialize. So we've been involved, I would say, tangibly, not on the tangent of the matter, not really focused on it. But we have, because there's a lot of things from the steel industry that can become construction material. So, we look at it as how can we help support a circular economy in some ways where, for example, the steel slag can become construction material, or, if you do methane pyrolysis and you have carbon black, how can that go into that segment? And obviously, the opportunities there, just because of the emission footprint of cement, is it's complex. So we have, looking at it that way, we think that there's new materials coming in. We think that when we think about the composition of those in 10, 20 years, they're going to be substantially different, like they were commenting today. And we're looking to see how we can, from the steel industry and from other dynamics of the energy transition, contribute to support new materials that specifically go around this circular economy, where what's something waste can become part of a building product. We have a massive challenge ahead of us of decarbonizing the system and then eventually removing all the CO2 that we put into the atmosphere. So first we need to get in net zero, and then we got to remove a lot of CO2. And we don't see a model where we get to any reasonable objective without using every single tool we have to try to reduce emissions. So if we would try to define the pecking order of the things we're trying to solve with the energy transition, you will say, first, I want to decarbonize it. Second, I want to get rid of fossil fuels. But if the second gets in the battle with the first one, we're in a bad position. Today, we need to get down emissions. And carbon capture in many situations is the cheapest way to decarbonize to an already super costly energy transition. We're talking about $1 trillion capex investment per year that is required. So how do we get there faster? It's clear that carbon capture needs to play a role. If we eliminate that tool from the toolkit, it's going to take 30 more years and cost many $1 trillion more. So then you say, well, there's the moral hazard, or we're going to continue to use fossil fuels. It's a perspective. We accept that some funds and some operators want to operate under that world. We are operating more in the world of let's be pragmatic and let's decarbonize the region. That is what we need. We spend a lot of time in geographies like, for example, Latin America, that obviously have a harder time financing new capital. And carbon capture provides a lower cost option to decarbonize existing assets without having to rebuild everything. So I think removing it from the toolkit and saying it's a bad idea is just a very expensive proposition. And it's a proposition that is going to get us further away from the objective. So in that compromise, we try to be pragmatic, and we support the use of carbon capture to do the most important thing that we need to do today, that is to lower the emissions of CO2. We're based in Milan. We're super excited that TDK is opening its presence in Europe, and this event is another show of what TDK does and the kind of quality talent that they put together, and the ability for us to meet and discuss very interesting topics. I mean, in the last 2 days, we went through a series of all super relevant with incredible speakers, themes, very specific, not 30,000 feet, but actual specifics, which is very valuable. And then the quality of the startup was fantastic. So thank you very much to TDK. It was a great couple of days here in London.